Okay, let's dive right into this. If you've ever felt like investing is just this totally rigged game where the house always wins, honestly, you are not alone. Today, for our explainer, we're looking at a fascinating, really data-driven framework we found in Adam Koo's Secrets of Self-Made Millionaires. Specifically, we're focusing on Chapter 17, which is all about winning with mutual funds. We're going to discover exactly how master investors cut through all the daily market noise to consistently find the absolute best funds in the world.
Here's our roadmap for today. We're going to uncover the mutual fund paradox, dig into why most investors actually lose their money, and then reveal the master investor's secret to winning. After that, we'll walk through 4 essential screens for success and wrap up with a highly practical 5-step playbook to help you spot those top funds.
All right, part 1, the mutual fund paradox. Is it a safe haven or practically a guaranteed loss?
Before we get to the shocking data, let's just make sure we're on the same page. What exactly are we talking about here? Well, a mutual fund, which is very often called a unit trust over in Asia, is simply an investment vehicle. It pools money from a bunch of individual investors, like you and me. Then, a professional manager takes that pooled cash and invests it into a wide variety of stocks, bonds, or other securities. The whole selling point is to give you broad diversification and professional management. Sounds incredibly safe and reliable, right? Well, let's take a look at the actual data.
And this brilliantly illustrates the massive problem we're facing. A staggering 90% of mutual funds either lose money or just flat out underperform the general stock market over time. I mean, sure, about 7 to 10% might beat the S&P 500 in any single random year. But the truly elite? Less than 3% of funds are able to consistently beat the market over a 5 to 10-year stretch. You literally have better odds sitting at a blackjack table than just randomly guessing which mutual fund is going to win long term.
And the consequences of not understanding this paradox are absolutely severe. $680 million. To put that into perspective, that is the staggering amount of money lost by 559,000 Singaporeans who invested their hard-earned CPF savings into unit trusts in the year 2004 alone. They completely trusted the system, and the system totally failed them.
Moving on to Section 2, why most investors lose. We're going to look at the hidden traps that are quietly destroying your wealth.
Adam Koo identifies 4 main reasons why retail investors consistently lose in the mutual fund game. First off, you have incredibly high sales charges and annual management fees. Second, there's this dangerous habit of chasing the hottest short-term performing funds. Third, folks rely on a very limited local selection of funds pushed by their local bank. And fourth, there's just a complete lack of research knowledge and the right tools. It's almost unbelievable how many people blindly trust the advice of their bank managers, who, let's be real, are effectively salespeople, instead of looking at the hard data themselves. Let's zoom in on that first trap for a second. The fees. When you buy a standard retail fund from a bank, you're typically getting hit with a 5 to 6% front load plus another 1.5 to 2% annual management fee. Think about that for a second. Before your money even goes to work, you are starting in a massive 6.5 to 8% deficit. Your fund literally has to beat the market by 8% just for you to break even. Master investors, they absolutely refuse to play this game. They only buy what are called no-load funds. That means there's a 0% front load, so every single dollar you invest goes to work for you immediately.
So, the crucial point here is avoiding the marketing trap. You know those glossy bank brochures that love to highlight a fund that went up 65% in the last 6 months? Yeah, chasing last year's highest performer almost always leads to disaster. Those spectacular short-term funds are usually just riding a massive momentum wave in a totally overvalued, hot sector that's practically destined to crash. Meanwhile, the 3% of funds that actually win consistently over a decade, they're often quietly sitting in non-hot sectors, just steadily building wealth. Which brings us to Section 3, the secret to winning. Let's figure out how to find that elusive 3%.
The answer, according to the framework in the book, is adopting an ultimate filter. To overcome this whole mutual fund paradox, you simply cannot rely on emotions or flashy bank marketing. You have to rely on strict, completely emotionless screening. We are looking for the top 1% of the roughly 8,000 available funds out there. We want funds that have consistently beaten the S&P 500 for 10 full years, carry the absolute lowest fees possible, and exhibit the lowest volatility.
Let's break exactly how to do that down in Section 4, 4 screens for success. This is the master investor's criteria. Now, what's really interesting about this is how clinical and specific these targets are.
Screen 1 ensures long-term performance. The fund has to beat the S&P 500 not just last year, but over 1, 3, 5, and 10-year periods. Screen 2 guarantees strong management. We want the exact same manager at the helm for over 5 years in a fund size between $50 million and $3 billion. That way it's not too small to be unstable, but not so huge that it's sluggish. Screen 3 demands low expenses, absolutely no front loads, and an expense ratio below the category average. And finally, Screen 4 ensures low risk. We want a Morningstar risk rating of 3 or below, a low standard deviation, which just means low volatility, and a Sharpe ratio greater than 1. And that Sharpe ratio? It simply means the fund is highly rewarding you for the minimal risk it's taking.
All right, let's get practical. In Section 5, 5 steps to top funds. Here is your actionable playbook.
Adam Koo outlines this beautifully simple, purely chronological 5-step roadmap. And the best part? It uses entirely free online tools. We're going to start with the Morningstar Mutual Fund Screener, enter our strict criteria, rank those results, verify them using Money Central's Research Wizard, and then finally check the fund's valuation right before purchasing.
Starting with steps 1 and 2, you just head over to Morningstar.com and fire up their free mutual fund screener. This is where you input that master investor criteria we just talked about. You literally just check the boxes for no-load funds only, set the manager tenure to greater than 5 years, and demand that the returns be greater than or equal to the S&P 500 for the year-to-date, 1-year, 3-year, 5-year, and 10-year periods. Hitting Show Results here instantly eliminates the vast majority of mediocre, fee-heavy funds. Just gone.
Now that initial screen will usually leave you with a refined list of, say, 10 to 30 elite funds. But step 3 is absolutely crucial. Just because a fund passes the screener doesn't make it an automatic buy. You need to rank these surviving funds from best to worst. You do this by scoring the results based on high 3-year, 5-year, and year-to-date returns to really pinpoint the absolute best of the best.
Let's move on and see how this builds into step 4. You take the ticker symbol of your top-ranked fund, say MaxX, for example, and you run it through the research wizard on MoneyCentral.com. This is exactly where you verify Screen 4. You are confirming that the standard deviation is indeed low and that the Sharpe ratio is greater than 1. If a fund fails this risk test, you just mercilessly cut it from your list and move on to the next one.
Finally, we hit step 5. Before you execute any trade online, you must make sure the fund isn't currently overvalued. You do this by checking its price to earnings or PE ratio. You're looking for a PE ratio of less than 20, and it should definitely be below the category average. Once you confirm it's actually trading at a fair value, you just check the minimum initial investment rules, log right into your online brokerage, and make your purchase.
This entire process literally takes just minutes once you learn how to do it, and it perfectly encapsulates the core philosophy of Adam Koo's framework. As he puts it, when you know how to find mutual funds that have been consistently beating the S&P 500, you can pick winning funds that give you returns of 13 to 20% a year. It's not about luck, right? It's about having the right financial intelligence and utilizing the right screens.
So, I want to leave you with this question to really think about today. Look closely at your current mutual fund portfolio. Does it actually pass these 4 screens? Or are you paying a 6% front load and a 2% annual fee for someone else to just slowly lose your money? We now have the exact blueprint to find the top 3% of funds in the world. It's time to put that knowledge to work. Thanks so much for joining me on this explainer, and I'll see you next time.